All right, folks, my next guest took a trip down memory lane with his note to his clients last week. I'm going to bring in out JPMorgan Chief Global Strategist David Kelly. And David, I love the way you wrote about this lunch you had March 6, 2009. And I guess you want to bet on how long it would take for the market to recover. And of course, the bottom, I guess, is March 9th, right? And this is interesting because it coincides with what I was just kind of talking about with the audience. This change in the market, something amazing has happened because profit margins were growing at a pretty steady pace. But what's happened here is just something that's just absolutely mind-boggling, and the stock market has gone along with it. Just to put it in a different perspective, corporate profits, as a percentage or a share of national income, they've caught up with it. So, what exactly is going on, and to what degree does this justify the rally?
Well, I think, first of all, we've seen an extraordinary rally. And in some ways, we've actually been in a 40-year bull market. I know that sounds ridiculous, but if you look at the profit share of GDP, that's when it started to rise. It's also when the value of the market relative to the size of the economy began to take off. I mean, back in '87, the stock market was worth 77% of GDP. It's 365% today. So we've had this long run. There's a lot to it, but I think one part of it is corporations being very good at holding down costs and making sure the productivity gains actually go to the bottom line. That's one part of the story.
Productivity gains, I always think, is a euphemism for firing people. I know it's not technically, but it feels like that's, a company says XYZ lays off 20,000 workers, and sometimes you'll see the stock is up more often than it's down.
Well, yeah, and we've got that. And we've got technology and so forth, but I think what companies have been really good at doing is making sure that the labor force doesn't get a bigger share of that. And so what we've seen is that the compensation share of GDP has gone down and the profit share of GDP has gone up. And then also we've had a lot of concentration of income in the hands of richer households, and they poured it into the stock market, and that's just pushing up PE ratios. So PE ratios are very high today, partly because people, yes, it's confidence, but also, frankly, there's a lot of money just flowing into the market from richer households who've been doing very well in this economy.
So it's a virtuous cycle, though, right? I mean, so where does that come with the market? Because I feel like you've been somewhat cautious about this rally for some time. And again, profit margins near 14%. There were decades when it was between 6 and 8%. So again, maybe the market's ahead of itself, but it's corporations have never had it this good.
Oh yeah, absolutely. And I believe in being a long-term investor, and I believe being a long-term investor in U.S. stocks. But what I see is a lot of people have got a very concentrated position. They're way overweight large cap U.S. equities. They don't have any exposure or very little exposure to the rest of the world. They don't have enough exposure to alternatives. So I just see that concentrated position. And the thing is, these numbers are wonderful. And every year or every quarter you get your returns come in a statement. They never put down risk. And sooner or later, I remember that lunch. It was actually on March 6th of 2009. But in that stock market crash, the market fell by 57%. And so I think people have had a great few years here. They just need to be balanced and not get over.
And there are a lot of people who don't know about that, right? They've never experienced that kind of a dip. We had the COVID dip. That was 1 month almost, right? So, in the meantime, you've been concerned about tariffs.
Yes.
But we're seeing they haven't had the bite yet. And there's some interesting things going on. Prices, particularly from items coming from China, and then I look at Costco. They reported on a Friday, and they haven't really been able to pass on costs. The stock gap down Friday. It's under a lot of pressure. It's pulling back. So, how afraid should we be about tariffs, even if it's not going to live up, I don't think, to the hype that we've had in May or April?
Well, the money is still coming into Treasury. The Treasury Department's going to take in another $30 billion this month. It's taking a while for companies to pass it on because, frankly, they've been scared about consumers not being willing to pay.
Yeah, after that shock, right? We had the 9.2% inflation rate.
Yeah. So, but what I think is going to happen is early next year we're going to have a boatload of refunds because the OBBBA really was built in huge refunds for 2026. When that money hits consumers early next year, I think that's when companies are going to take the opportunity. How much should it cost? Well, how much can you afford, basically? Right. And so that's when I think companies will, all the big retailers will say, okay, this is our chance to mark up prices just like they did during the pandemic.
Let's talk about the jobs report on Friday, right? Because I think the street is around 50,000, unemployment rate 4.3. You're about there. Did I read yours around 60,000?
60,000, exactly.
What's the most important thing we should be looking for to take away from this report on Friday?
It's labor force participation. I mean, we've got two economies here. It's not as strong as the Atlanta Fed at 3.8. But it's not as weak as a jobs report of 50,000. It's somewhere in the middle. But what's going on here is if we have less labor supply for the aging of the baby boom, change around in immigration, but less labor supply, then even very slow payroll job gains can keep the unemployment rate low. It does, in the long run, though, slow down economic growth.
Where does that put the Fed?
I honestly don't think the Fed should be easing here. I think that the market.
You don't think they should, but you think they will.
No, I think they will. I think they feel that a neutral rate is 3%, and I think they'll use that as a fig leaf to cut rates twice more this year, twice next year. They'll get down to 3, and then they'll kind of stop there because really, the economy is healthy enough, but we've got a tortoise of an economy, we've got a hare of a market.
Gotcha. Great. Love our conversations.
Anytime,
Thanks a lot.